Chapter number 13, ICAI study material questions. Case study, consolidation of financial statements of a subsidiary. Parent Limited acquired 51% shares of Child Limited during the year ended 31st March 2021. During the financial year 21-22, 20% shares of Child Limited were sold by Parent Limited. Parent Limited, while preparing the financial statements for the year ended 31st March 2021 and 31st March 2022, did not consider the financial statements of Child Limited for consolidation. As a statutory auditor, how would you deal with it? Provisions and explanation. As per Ind AS 110, there is no such exemption for temporary control or for operation under severe long-term funds transfer restrictions, and consolidation is mandatory for Ind AS compliant financial statements in this case. However, as per Section 129 subsection 3 of the Companies Act 2013, where a company having subsidiary which is not required to prepare consolidated financial statements under the applicable accounting standards, it shall be sufficient if the company complies with the provisions of consolidated financial statements provided in Schedule 3 to the Act. Conclusion: in the given case, Parent Limited acquired 51% shares of Child Limited during the year ended 31st March 2021 and sold 20% shares during the year ended 31st March 2022. Parent Limited did not consolidate the financial statements of Child Limited for the year ended 31st March 2021 and 31st March 2022. The intention of Parent Limited is quite clear that the control in Child Limited is temporary, as the former company disposed of the acquired shares in the next year of its purchase. Parent Limited is required to prepare consolidated financial statements in accordance with Ind AS 110 as exemption for temporary control or for operation under severe long-term funds transfer restrictions is not available under Ind AS 110. Paragraph 20 of Ind AS 110 states that consolidation of an investee shall begin from the date the investor obtains control of the investee and cease when the investor loses control of the investee. Next, test your understanding 1. C.A. Mukund is in the second year of his term as statutory auditor of Style Marks Limited, holding company, its subsidiary, and joint ventures. At the time of planning audit, he wants to be sure that all the components have been included in the consolidated financial statements. List out some procedures he should perform to verify completeness of this information. The auditor should verify that all the components have been included in the consolidated financial statements unless these components meet criterion for exclusion. In respect of the completeness of this information, the auditor should perform the following procedures. Review his working papers for the prior years for the known components. Review the parent's procedures for identification of various components. Make inquiries of the management to identify any new components or any component which goes out of consolidated financial statements. Review the investments of parent as well as its components to determine the shareholding in other entities. Review the joint ventures and joint arrangements as applicable. Review the other arrangements entered into by the parent that have not been included in the consolidated financial statements of the group. Review the statutory records maintained by the parent, for example, registers under Section 186, 190 of the Companies Act 2013. Also identify the changes in the shareholding that might have taken place during the reporting period. Next, test your understanding question number 2. CA Kajal is nearing completion of audit of consolidated financial statements of Rubik Paints and Chemicals Limited. She requires written representations from the parent's management on matters material to the consolidated financial statements. What specific matters should such written representation can include? The auditor of the consolidated financial statements should obtain written representations from the parent's management on matters material to the consolidated financial statements. Examples of such representations include completeness of the components included in the consolidated financial statements, identification of reportable segments for segment reporting, identification of related parties and related party transactions for reporting, appropriateness and completeness of permanent and current period consolidation adjustments, including the elimination of intragroup transactions. Test your understanding 3. CAM is auditor of consolidated financial statements of D&D Limited for the year 22-23. The consolidated financial statements consists of financial statements and financial information of 8 subsidiaries audited by other auditors. Such financial statements, financial information, and auditors' reports of the subsidiaries have been furnished by the management of D&D Limited to him. Following further information is also available in respect of these 8 subsidiaries for the year 22-23. Total assets 1500 crores, total revenue 1000 crores, net cash outflows 10 crores. Two of these subsidiaries Two of these subsidiaries are located outside India, whose financial statements have been prepared in accordance with accounting principles generally accepted in their respective countries and which have been audited by other auditors under auditing practices. Generally accepted auditing standards applicable in their respective countries. Where and how such information should be included in the independent auditor's report on consolidated financial statements of the company. Also draft a suitable para by making necessary assumptions. In a case where the parent's auditor is not the auditor of all the components, including the included in the consolidated financial statements, then as prescribed in SS 706, if the auditor considers it necessary to make reference to the audit of other auditors, the auditor's report on the consolidated financial statements should disclose clearly the magnitude of the portion of the financial statements audited by the other auditors. This may be done by stating aggregate rupee amounts or percentages of total assets, revenues, and cash flows of components included in the consolidated financial statements not audited by the parent's auditor. It should be included in the other matter paragraph of the independent auditor's report. The draft other matter paragraph is as under. Other matter paragraph: we did not audit the financial statements or other financial information in respect of the 8 subsidiaries whose financial statements include total assets of 1500 crores as at 31st March 2023 and total revenues of 1000 crores and net cash outflow of 10 crores for the year ended on the date. These financial statements and other financial information have been audited by other auditors, and such financial statements, other financial information, and auditors' reports have been furnished to us by the management of the holding company. Our opinion on the consolidated financial statements, insofar as it relates to the amounts and disclosures included in respect of these subsidiaries and joint venture, and our report in terms of Section 143, subsection 3 of the Act, insofar as it relates to the aforesaid subsidiaries, is based solely on the reports of such other auditors. Two of these subsidiaries are located outside India, whose financial statements and other financial information have been prepared in accordance with the accounting principles generally accepted in their respective countries and which have been audited by other auditors under generally accepted auditing standards applicable in their respective countries. The holding company's management has converted the financial statements of such subsidiaries from accounting principles generally accepted in their respective countries to accounting principles generally accepted in India. We have audited these conversion adjustments made by the holding company's management. Our opinion, insofar as it relates to the balances and affairs of such subsidiaries, is based on the report of other auditors and the conversion adjustments prepared by the management of the holding company and audited by us. Our opinion on the consolidated financial statements and our report on other legal and regulatory requirements is not modified in respect of above matters with respect to our reliance on the work done and the reports of the other auditors and the financial statements and other financial information certified by the management. Integrated case scenario. While auditing consolidated financial statements of YK Industries Limited for the year 22-23, a manufacturing company whose financial statements are required to be prepared in accordance with Division 2 of Schedule 3 of Companies Act 2013, CAP notices as under the notes to accounts in respect of consolidated financial statements disclose additional information pertaining to the holding company and its subsidiary. It provides disclosures regarding percentage of consolidated net assets, of consolidated P&L, and of total comprehensive income, along with their respective amounts pertaining to holding company and its subsidiary. It is noticed by him that financial statements of one foreign subsidiary included in consolidated financial statements as drawn up to 31st March 2022 in accordance with the legal requirements in US. He feels it to be weird and is of the view that consolidated financial statements of group could present a distorted picture. The management in turn informs him that it is not practicable to draw the financial statements of a foreign subsidiary to 31st March 2023. During the year 22-23, goodwill of 50 crores has arisen on account of the acquisition of a subsidiary during the year, and there is no impairment loss as on the balance sheet date. Besides, adjustments have been made in consolidated financial statements with respect to intra-group indebtedness and those related to harmonizing different accounting policies being adopted by parent and its subsidiary. It is noticed by him that one subsidiary was acquired on 15th June 2022. He is in a dilemma as regards to the correctness of consolidation of its financial statements in group financial statements. Besides, he is also in the process of finalizing the audit report, including matters to be reported under CARO 2020 in respect of the consolidated financial statements. However, he is in a fix in respect of manner of reporting under CARA 2020 relating to consolidated financial statements. Based upon above information and description, answer the following questions. Considering disclosure of additional information in consolidated financial statements as stated in para A of case study, which of the following statement is correct? The said disclosure is not proper as percentage of consolidated revenue from operations along with the respective amount pertaining to holding company and its subsidiary is also required. The said disclosure is not proper as percentage of other comprehensive income along with the respective amount pertaining to holding company and its subsidiary companies is also required. The said disclosure is not proper as percentage of consolidated revenue from operations as well as other comprehensive income along with their respective amounts pertaining to holding company and its subsidiary are also required. The said disclosure is proper. Option B is correct. The said disclosure is not proper as percentage of other comprehensive income along with respective amount pertaining to holding company and its subsidiaries is also required. Next, what should be the auditor's proper course of action pursuant to situation highlighted in para B relating to financial statements of a foreign subsidiary? The auditor should insist for drawing up of the financial statements of foreign subsidiary to 31st March 2023. The reason for impracticality is a mere excuse. In case of failure to redraw, he can modify his opinion in accordance with SS 705. Second option, the auditor can accept management's version. Third option, the auditor can accept management's version. However, it is his duty to verify adjustments made for effects of significant transactions or events occurring between 1st January 2023 and 31st March 2023. Fourth option, the auditor should modify his opinion by quantifying the financial effects of such an inconsistency. Option C is correct. The auditor can accept management's version. However, it is his duty to verify adjustments made for effects of significant transactions or events occurring between 1st January 2023 and 31st March 2023. Next, third option. Which of the following statements is correct with respect to goodwill and other matters described in the case scenario? Goodwill represents current period consolidation adjustments, adjustments relating to intragroup indebtedness, and those relating to harmonizing different accounting policies being adopted by the parent and its subsidiaries represents permanent consolidated adjustments. Second option, adjustments relating to goodwill, intragroup indebtedness, and those relating to harmonizing different accounting policies being adopted by the parent and its subsidiaries represents current period consolidation adjustments. Third one, goodwill represents permanent consolidation adjustments, adjustments relating to intra-group indebtedness and those related to harmonizing different accounting policies being adopted by the parent and its subsidiaries represents current period consolidation adjustments. Third one, goodwill. Fourth one, goodwill and adjustments relating to harmonizing different accounting policies being adopted by the parent and its subsidiaries represents permanent consolidation adjustments. Adjustments relating to intragroup indebtedness represents current period consolidation adjustments. Option C is correct. That is, goodwill represents permanent consolidation adjustments. Adjustments relating to intragroup indebtedness and those related to harmonizing different accounting policies being adopted by the parent and its subsidiaries represents current period consolidation adjustments. Next, which of the following statement is most appropriate regarding consolidation of financial statements of a subsidiary acquired on 15th June 2022? There are four options. First option, the auditor should verify that income and expense of a subsidiary are included in the consolidated financial statements from the date it gains control of the subsidiary, and further, such income and expenses are based on the amounts of the assets and liabilities recognized in consolidated financial statements at the acquisition date. Next, the auditor should verify that income and expenses of a subsidiary are included in the consolidated financial statements for the complete financial year, and further, such income and expenses are based on the amounts of assets and liabilities recognized in consolidated financial statements at the preceding reporting date. Third, the auditor should verify that income and expense of a subsidiary are included in the consolidated financial statements from the date it gains control of subsidiary, and further, such income and expenses are based on the amounts of the assets and liabilities recognized in consolidated financial statements at the preceding reporting date. Fourth, the auditor should verify that income and expenses of subsidiary are included in the consolidated financial statements for the complete financial year, and further, such income and expenses are based on the amounts of assets and liabilities recognized in consolidated financial statements at the acquisition date. Option A is correct. That is, the auditor should verify that income and expenses of a subsidiary are included in the consolidated financial statements from the date it gains control of subsidiary, and further, such income and expenses are based on the amounts of the assets and liabilities recognized in consolidated financial statements at the acquisition date. Next, as regards reporting under CARO 2020 in respect of consolidated financial statements, which of the following is in accordance with the requirements of the law? There are four options. First option is separate report providing clause by clause reporting under CARO 2020 is required in respect of specified matters pertaining to parent and all subsidiaries incorporated in India. Second one, it would be sufficient if a report under CARO 2020 in respect of standalone financial statements is supplemented with additional information in respect of all subsidiaries incorporated in India. Third one, a separate report under CARA 2020 in respect of all subsidiaries incorporated in India together is required. It should be annexed with a report under CARA 2020 in respect of the standalone financial statements. Fourth option, reporting of details of subsidiaries together with paragraph numbers of reports under CARA 2020 of auditors of such companies incorporated in India containing qualifications or adverse remarks would serve the purpose. Option D is correct. Reporting of details of subsidiaries together with paragraph numbers of reports under CARA 2020 of auditors of such companies incorporated in India containing qualifications or adverse remarks would serve the purpose. Test your knowledge. Question number one. whether preparation of consolidated financial statements is mandatory? If yes, please elaborate on the requirements under the statute. Consolidation of financial statements. Mandatory under Companies Act 2013. According to Section 129, subsection 3 of Companies Act 2013, where a company has one or more subsidiaries, including associate company and joint venture, it shall, in addition to its own financial statements, prepare a consolidated financial statements of the company and of all the subsidiaries in the same form and manner as that of its own. Further, Section 129, subsection 4 of the said Act provides that the provisions applicable to the preparation, adoption, and audit of the financial statements of a holding company shall mutatis mutandis also apply to its consolidated financial statements. The consolidated financial statements shall also be approved by Board of Directors before they are signed on behalf of the board along with its standalone financial statements and shall also be laid before the annual general meeting of the company along with the laying of its standalone financial statements. The company shall also attach, along with its financial statements, a separate statement containing the salient features of the financial statements of its subsidiary or subsidiaries in Form AOC 1. According to Company Account Rules 2014, the consolidation of financial statements of the company shall be made in accordance with the provisions of Schedule 3 to the Act and the applicable accounting standards. However, a company is not which is not required to prepare consolidated financial statements under the accounting standards, it shall be sufficient if the company complies with the provisions of consolidated financial statements provided in Schedule 3 of the Act. However, the requirement relating to preparation of consolidated financial statements shall not apply to a company if it meets the following conditions. It is a wholly owned subsidiary or is a partially owned subsidiary of another company and all its other members, including those not otherwise entitled to vote, have been intimated in writing and for which the proof of delivery of such intimation is available with the company do not object to the company not presenting consolidated financial statements. It is a company whose securities are not listed and are not in the process of listing on any stock exchange, whether in India or outside India, and its ultimate or any intermediate holding company files consolidated financial statements with the registrar, that is ROC, which are in compliance with the applicable accounting standards. Further, an investment entity need not present consolidated financial statements if it is required in accordance with the paragraph 31 of Ind AS 110 to measure all of its subsidiaries at fair value through profit or loss. A parent shall determine whether it is an investment entity or not. However, as per para number 33 of Ind AS 110, the parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity subsidiary, unless the parent itself is an investment entity. Next, test your knowledge question number 2. Please elaborate on the situations wherein the requirements relating to preparation of consolidated financial statements may not apply. The requirements related to preparation of consolidated financial statements shall not apply to a company if it meets the following conditions. It is wholly owned subsidiary or is a partially owned subsidiary of another company and all its other members, including those not otherwise entitled to vote, having been intimated in writing and for which the proof of delivery of such intimation is available with the company, do not object to the company not presenting consolidated financial statements. It is a company whose securities are not listed and are not in the process of listing on any stock exchange, whether in India or outside India, and its ultimate or any intermediate holding company files consolidated financial statements with the registrar. Registrar means ROC, which are in compliance with applicable accounting standards. Test your knowledge question number 3. While doing the audit of consolidated financial statements, which current period consolidation adjustments are to be taken into account? Current period consolidation adjustments. Current period consolidation adjustments are those adjustments that are made in the accounting period for which the consolidation of financial statements is done. Current period consolidation adjustments primarily relates to the elimination of intragroup transactions and account balances, including intragroup interest paid and received or management fees, etc. Unrealized intragroup profits on assets acquired or transferred from or to other subsidiaries, record deferred taxes on unrealized intercompany profits, elimination in accordance with Ind AS 12, intragroup indebtedness, adjustments related to harmonizing the different accounting policies being followed by the parent and its subsidiary and its components, adjustments to the financial statements of the parent and the components being consolidated for recognized subsequent events or transactions that occur between the balance sheet date and the date of auditor's report on the consolidated financial statements of the group. Next, test your knowledge. Question number 4. Write short notes on responsibility of holding company for preparation of consolidated financial statements. Responsibility of parent. The responsibility for preparation and presentation of consolidated financial statements, among other things, is that of the management of the parent. This includes identifying components and including the financial information of the components to be included in the consolidated financial statements. Where appropriate, identifying reportable segments for segment reporting, identifying related parties and related party transactions for reporting, obtaining accurate and complete financial information from components, making appropriate consolidation adjustments, harmonization of accounting policies and accounting framework, and gap conversion where applicable. Test your knowledge. Question number 4, part 2. Write a short notes on permanent consolidation adjustments. Permanent consolidation adjustments. Permanent consolidation adjustments are those adjustments that are made only on the first occasion or subsequent occasions in which there is a change in the shareholding of a particular entity which is consolidated. Permanent consolidation adjustments are determination of goodwill or capital reserve as per the applicable accounting standards, determination of amount of equity attributable to minority or non-controlling interest. Next, test your knowledge. Question number 5. R Limited owns 51% voting power in S Limited. It, however, holds and discloses all the shares as stock in trade in its accounts. The shares are held exclusively with a view to their subsequent disposal in the near future. R Limited presence represents that while preparing consolidated financial statements, S Limited can be excluded from the consolidation. As a statutory auditor, how would you deal? Consolidation of financial statements. As per Ind AS 110, there is no such exemption for temporary control or for operation under severe long-term funds transfer restrictions, and consolidation is mandatory for Ind AS compliant financial statements. In this case, paragraph 20 of Ind AS 110 states that consolidation of an investee shall begin from the date the investor obtains control of the investee and cease when the investor loses control of the investee. However, as per section 129, subsection 3 of the Companies Act 2013, read with Rule 6 of the Company Accounts Rules 2014, where a company having subsidiary which is not required to prepare consolidated financial statements under the accounting standards, it shall be sufficient if the company complies with the provisions on consolidated financial statements provided in Schedule 3 to the Act. In the given case, R Limited's intention is to dispose of the shares in the near future, as the shares are being held as a stock in trade, and it is quite clear that the control is temporary. Therefore, R Limited is required to prepare consolidated financial statements in accordance with Ind AS 110, as exemption for temporary control is not available under Ind AS 110. Next, test your knowledge. Question number 6. A Limited holds the ownership of 10% of the voting power and control over the composition of board of directors of B Limited. While planning the statutory audit of A Limited, what factors would be considered by you as the statutory auditors of A Limited for the audit of its consolidated financial statements prepared under Ind AS? 10% voting power and control over composition of board of directors. In this case, A Limited holds only 10% of the voting power but has control over the composition of board of directors of B Limited. In such a case, A Limited shall be considered as a parent of B Limited and therefore it would consolidate B Limited in its consolidated financial statements as a subsidiary. The auditor should verify A Limited's management's assessment of having control in B Limited despite having only 10% voting power. As per the requirements of Ind AS 110, auditor would need to verify as to how A Limited controls the composition of a board of directors or corresponding governing body of B Limited. There can be various means by which such kind of control can be established. In this regard, the auditor may verify the minutes of board meetings, shareholder agreement entered into by the parent, agreements with B Limited to which the parent might have provided any technology or know-how, enforcement of statute, etc. Further, the auditor should verify that the adjustments warranted by Ind AS 110 have been made wherever required and have been properly authorized by the management of the parent. The preparation of consolidated financial statements gives rise to permanent consolidation adjustments and current period consolidation adjustments. The auditor should make plan, among other things, for the understanding of accounting policies of A Limited and B Limited and determining and programming the nature, timing, and extent of audit procedures to be performed, etc. Further, the duties of an auditor with regard to reporting of transactions with any other related parties are given in the SA 550 on related parties. As per SA 550 on related parties, the auditor should review information provided by the management of the entity, identifying the names of all known related parties. A person or other entity that has control or significant influence, directly or indirectly, through one or more intermediaries over the reporting entity are considered as related party. In forming an opinion on the financial statements, the auditor shall evaluate whether the identified related party relationships and transactions have been appropriately accounted for and disclosed in accordance with Ind AS 110 and Schedule 3, and whether the effects of the related party relationships and transactions prevent the financial statements from achieving true and for fair presentation framework or cause the financial statements to be misleading for compliance frameworks. Next, test your knowledge question number 7. You are appointed as an auditor of Nawab Limited, a listed company who is a main supplier to the UK building and construction market. With a turnover of 2.9 billion, the company operates through 11 business units and has nearly 180 branches across the countries. As an auditor, how will you draft the report in case when the parent's auditor is also the auditors of all its components? Second, when the parent's auditor is not the auditor of all its components. Third, when the component's auditor reports on financial statements under an accounting framework different than the that of the parent. Fourth, when the component's auditor reports under an auditing framework different than of the parent, where the financial statements of one or more components is not audited. Reporting can be done in five cases. Five cases. How reporting will be done? First one, when the parent's auditor is also the auditor of all of its components. Second, when the parent's auditor is not the auditor of its components. Third, when the components auditors report on financial statements under an accounting framework is different than that of the parent. Fourth, when the components auditors reports under an account auditing framework different than of the parent. Fifth, components not audited. First case, when the parent's auditor is not the is also the auditor of all of its components. In such a case, while drafting the audit report, the auditor should report whether principles and procedures for preparation and presentation of consolidated financial statements as laid down in the relevant accounting standards have been followed. In case of any departure or deviation, The auditor should consider the requirements given in SA 705, modifications to the opinion in the independent auditor's report, in the audit report, so that users of the consolidated financial statements are aware of such deviation. Auditors should issue an audit report expressing opinion whether the consolidated financial statements give true and fair view of the state of affairs of the group as on balance sheet date, and as to whether consolidated profit and loss statement gives true and fair view of the results of a consolidated profit or loss of the group for the period under audit. Where the consolidated financial statements is also include a cash flow statement, the auditor should also give his opinion on the true and fair view of the cash flows presented by the consolidated cash flow statements. Next, when the parent's auditors is not the auditor of all of its components, in a case where parent's auditors is not the auditor of all the components included in the consolidated financial statements, the auditor of the consolidated financial statements should also consider the requirements of SS 600 as prescribed in SS 706. If auditor considers it is necessary to make reference to the audit of the other auditors, the auditor's report on the consolidated financial statements should disclose clearly the magnitude of the portion of the financial statements audited by other auditors. This may be done by stating aggregate rupee amounts, or percentage of the total assets, revenues, and cash flows of the components included in the consolidated financial statements not audited by the parent's auditors. Total assets, revenues, and cash flows not audited by parent's auditor should be presented before giving effect to permanent and current period consolidation adjustments. Reference in the report of the auditor on the consolidated financial statements to the fact that part of the audit of the group was made by other auditor or auditors is not to be construed as a qualification of the opinion, but rather as an indication of a divided responsibility between the auditors of the parent and its subsidiary. Next, when the component or components auditors report on financial statements under an accounting framework different than that of the parent. In such a case, the parent's management should perform a conversion of components audited financial statements from the framework used by the component to the framework under which the consolidated financial statements are prepared. The conversion adjustments are audited by the principal auditor to ensure that the financial information of the components is suitable and appropriate for the purpose of consolidation. A component may alternatively prepare financial statements on the basis of a parent's accounting policies as outlined in the group accounting manual to facilitate the preparation of the group's consolidated financial statements. The principal or parent auditors should perform procedures necessary to determine compliance of group accounting policies with the gap applicable to the parent's financial statements. Next, when the components auditors reports under an auditing framework different than that of the parent. Normally, audit of financial statements, including consolidated financial statements, are performed under auditing standards generally accepted in India, Indian gas. In order to maintain consistency of the auditing framework and to enable the parent auditor to rely and refer to the other auditors' audit report in their audit report on the consolidated financial statements, the components financial statements should also be audited under a framework that corresponds to Indian gas. Components not audited. Generally, the financial statements of all components included in consolidated financial statements should be audited or subjected to audit procedures in the context of a multi-local audit group audit, multi-location group audit. Such audits and audit procedures can be performed by the auditor reporting on the consolidated financial statements or by the components auditors. Where the financial statements of one or more components continue to remain unaudited, the auditor reporting on the consolidated financial statements should consider unaudited components in evaluating a possible modification to his report on the consolidated financial statements. The evaluation is necessary because the auditor or other auditors, as the case may be, has not been able to obtain sufficient appropriate audit evidence in relation to such consolidated amounts or balances. In such cases, the auditor should evaluate both qualitative and quantitative factors on the possible effect of such amounts remaining unaudited when reporting on the consolidated financial statements using the guidance provided in SS 705, modifications to the opinion in the independent auditor's report. Next question, question number 8. Test your knowledge, question number 8. M Limited acquired 51% shares of S Limited on 1st April 2019 and sold 25% of these shares during the financial year 1920. M Limited did not prepare consolidated financial statements for the financial year 1920 on the plea that the control was only temporary. Do we agree with the view of M Limited? Decide assuming that M Limited is required to prepare its financial statements under Ind AS. Consolidation of financial statements. As per Ind AS 110, there is no such exemption for temporary control or for operating under severe long-term funds transfer restrictions, and consolidation is mandatory for Ind AS compliant financial statements. In this case, Ind AS 110 states that consolidation of an investee shall begin from the date the investor obtains control of the investee and cease when the investor loses control of the investee. In the given case, M Limited acquired 51% shares of S Limited on 1st April 2019 and sold 25% shares during the year ended 2019-20. M Limited did not consolidate the financial statements of S Limited for the year ended 31st March 2020 on the plea that control was only temporary. The intention of M Limited is quite clear that the control of S Limited is temporary, as the former company disposed of the acquired shares in the same year of its purchase. However, even though the intention of M Limited is for temporary holding of shares in S Limited, as per Ind AS, M Limited is required to prepare consolidated financial statements in accordance with Ind AS 110, as exemption for temporary control is not available under Ind AS 110. However, consolidation of an investee shall begin from the date the investor obtains control of the investee and ceases when the investor loses control of the investee. Here, due to sale of investment in S Limited up to 25%, M Limited loses control of S Limited. Accordingly, M Limited is required to prepare consolidated statement till the date of disposal of the 25% shares to comply with the same. Next, test your knowledge, question number 9. H Limited is an investment company preparing its financial statements in accordance with the Ind AS. The company obtains funds from various investors and commits its performance for fair return and capital appreciation to its investors. During the year under audit, it had been observed that the company had invested 25% in S1 Limited, 50% in S2 Limited, and 60% in S3 Limited of the respective share capitals of the investee company. When checking the investment schedule of the company, an issue cropped as to whether there would arise any need to consolidate accounts of any such investee companies with those of H Limited in accordance with Section 129, subsection 3 of the Companies Act 2013, which contains no exclusion from consolidation. Analyze the issues involved and give your views. Consolidated financial statements. According to Section 129, subsection 3 of the Companies Act 2013, where a company has one or more subsidiaries, including associate company and joint venture, it shall, in addition to its own financial statements, prepare a consolidated financial statements of the company and all of the subsidiaries in the same form and manner as that of its own. Further, as per Companies Account Rules 2014, the consolidation of financial statements of the company shall be made in accordance with the provisions of Schedule 3 to the Act and applicable accounting standards. However, a company which is not required to prepare consolidated financial statements under the accounting standards, it shall be sufficient if the company complies with provisions on consolidated financial statements provided in Schedule 3 of the Act. However, an investment entity need not present consolidated financial statements if it is required in accordance with Ind AS 110 consolidated financial statements to measure all of its subsidiaries at fair value through P&L, profit or loss. A parent shall determine whether it is an investment entity. An investment entity is an entity that obtains funds from one or more investors for the purpose of providing those investors with investment management services, commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both, and measures and evaluates the performance of substantially all of its investments on a fair value basis. In the given case, H Limited is an investment company preparing its financial statements in accordance with Ind AS, and the company has invested 25% in S1 Limited, 50% in S2 Limited, and 60% in S3 Limited of the respective share capitals of the investee company. In view of the provisions discussed in Ind AS 110, the company is not required to prepare consolidated financial statements. However, for the compliance of Companies Account Rules 2014, it shall be sufficient if the company complies with the provisions on consolidated financial statements provided in Schedule 3 of the Act. Thus, it can be concluded that ultimate authority on consolidation is AS or Ind AS as prescribed by law, and if they give some exemption, it shall be followed. If out of exemption, some subsidiaries are not consolidated, then list should be disclosed in notes to accounts with reasons. Next, test your knowledge question number 10. Venus Limited is a company engaged in the manufacturing of stainless steel items. The company operates through 5 business units and has 35 branches across India. Manglam and Associates are being appointed as the principal auditor of the company. While accepting the audit assignment as the principal auditor, what will be the points of consideration for the principal auditor of the company? Acceptance as principal auditor. The principal auditor, Manglam and Associates, should consider whether their own participation is sufficient to be able to act as the principal auditor. For this purpose, the auditor would consider materiality of the portion of the financial information which the principal auditor audits, the principal auditor's degree of knowledge regarding the business of the components, the risk of material misstatements in the financial information of the components audited by other auditor, and the performance of additional procedures as set out in this essays regarding the components audited by other auditor, resulting in the principal auditor having significant participation in such audit. Next, test your knowledge question number 11. Venus Limited is a curtain manufacturing company having its corporate office in Punjab. The company is in the process of expansion and has acquired 4 companies during the year. Pradyuman and Co. is the principal auditor of the company, while the audit of all the companies acquired during the year is being conducted by JA and JA Associates. During the course of audit, CA Pradyuman, the engagement partner, asked the management of Venus Limited at the corporate office that in order to conduct the audit of consolidated financial statements, his audit firm is required to conduct audit of the financial statements of all the companies also company acquired during the year. To this, the management asked CA Pradyuman to consider the audit reports of the component auditors already provided to his audit team and to communicate with the component auditor for any discussion they wish to have. CA Pradyuman contended that for the purpose of audit of consolidated financial statements, either his firm is required to conduct an audit of all the components' financial statements, or he needs the working papers of the component auditors. Is the contention of CA Pradyuman correct? As per SS 600, using the work of another auditor, the principal auditor is normally entitled to rely upon the work of the component auditor unless there are special circumstances to make it essential for him to visit the component and or to examine the books of accounts and other records of the said component. The principal auditor might discuss with the other auditor the audit procedures applied or review a written summary of the other auditor's procedures and findings, which may be in the form of completed questionnaire or checklist. The principal auditor may also wish to visit the other auditor. The nature, timing, and extent of procedures will depend on the circumstance of the engagement and the principal auditor's knowledge of the professional competence of the other auditor. the principal auditor should consider the significant findings of the other auditor. The principal auditor may consider it appropriate to discuss with the other auditor and the management of the component the audit findings or other matters affecting the financial information of the components. He may also decide that a supplemental test of records or the financial statements of the components are necessary. Such tests may, depending upon the circumstances, be performed by the principal auditor or the other auditor. Accordingly, CA Presuman can perform the above mentioned audit procedures. However, the audit of the component's financial statements by the principal auditor is not required. So, the contention of CA Presuman that for the purpose of audit of consolidated financial statements, he is required to conduct an audit of the component's financial statements is not correct. Further, SA 230, issued by ICAI on audit documentation and standards on quality control SQC1, provides that unless otherwise specified by law or regulation, audit documentation is the property of the auditor. He may, at his discretion, make portions of or extracts from audit documentation available to the clients, provided such disclosure does not undermine the validity of the work performed or, in the case of assurance engagements, the independence of the auditor or of his personnel. Accordingly, it is the discretion of the component auditor as the working papers with respect to the components examined by the component auditor are the property of the component auditor. So the contention of CA Presuman is not correct. Next, test your knowledge question number 12. Kukreja and Associates is the principal auditor of MN Limited. The company is engaged in the manufacture of sports items and operates through its 14 branches all over India. With respect to the audit of branches, the company has appointed 7 chartered accountant firms, each firm conducting the audit of 2 branches. The audit reports in respect of the accounts of branches have already been sent to the principal auditor. While analyzing the work of the branch auditors, CA Kukreja, the engagement partner, asked the branch auditors to share him with a summary of audit procedures and findings in respect of the accounts of the branches examined by them. CA Kukreja also asked one of the branch auditor to share his working paper with respect to the 2 branches examined by that branch auditor for his review and return. Is the principal auditor correct in asking the branch auditors for sharing the summary and the working papers for his review? In terms of SS 600, using the work of another auditor, where another auditor has been appointed for the component, the principal auditor would normally be entitled to rely upon the work of such auditor unless there are special circumstances to make it essential for him to visit the component and are to examine the books of accounts and other records of the said component. When planning to use the work of another auditor, the principal auditor should consider the competence of the other auditor in the context of the specific assignment. If the other auditor is not a member of ICAI, the principal auditor should perform procedures to obtain sufficient appropriate audit evidence that the work of other auditor is adequate for the principal auditor's purposes in the context of the specific assignment. The principal auditor might discuss with the other auditor the auditor's audit procedures applied or review a written summary of the other auditor's procedures and findings, which may be in the form of a completed questionnaire or checklist. Accordingly, CA Kukreja is correct in asking the branch auditors to share with him the summary of their audit proceedings, procedures, and findings in respect of the accounts of the branches examined by them. Further, CA Kukreja has asked one of the branch auditors to share with him the working papers with respect to the branches examined by such branch auditor for the former's review and return. SA 230, issued by ICAI on audit documentation and standards on quality control, SQC1, provides that unless otherwise specified by law or regulation, audit documentation is the property of the auditor. He may, at his discretion, make portions of or extracts from audit documentation available to clients, provided such disclosure does not undermine the validity of the work performed, or, in the case of assurance engagements, the independence of the auditor or of his personnel. Accordingly, it is the discretion of the branch auditor, as the working papers with respect to the branches examined by the branch auditors are the property of the branch auditor. So, CA Kukreja is not correct in asking the branch auditor to share him with the working papers with respect to the branches examined by the branch auditor.